Let's look back in history at two previous secular bear markets where the stock market went down dramatically and just traded sideways for literally years and years until it finally broke out to the upside, creating a new secular bull market that lasted for a long period of time. Let's take a look at those two cycles and compare where we are today to those previous two cycles. Let's first look at the stock market from 1930 until the early to mid 1940s. The Dow Jones Industrial traded between 240, and I said 40, and I really mean that. The Dow Jones got down to a price of 40. Now, of course, it's much higher than that. It's in the 14,000 range. But from 1930 to 1946, the stock market traded for that 16-year period of time in that broad range. Finally, in 1946, the stock market penetrated back above where it traded in 1930. So the people in 1946 said, thank goodness I'm back to break even to where I was back 16 years ago. Is it now the time to start looking at the idea of selling stocks? Now, if that had happened in 1946, if you'd sold stocks when the Dow was at 200, by 1966 the Dow was approaching 1,000, up 500% over that next 20-year period of time. So you would have missed that major secular bull market move on the upside following that long consolidation period of 1930 through 1946. The next major secular bear market took place between the late 1960s, let's call it 1969 and 1983. Over that period of time, the Dow traded between 400 and 1,000, back and forth numerous times, up and down, almost doubling in value or moving down 50% in value from 1968 to 1982. So over that 14-year period of time, finally in 1982, the stock market penetrated, the Dow penetrated 1,000, and people thought, thank goodness I'm back to where I was in the late 1960s as far as the value of my stocks is concerned. I think I'll sell my stocks at this time and just call it a day. Now, if that happened, and you had moved out of the stock market in 1982, when the Dow was at 1,000, you would have missed the move from 1,000 to 11,500 in the year 2000, when the market rose by 1,050% over that 18-year period of time, certainly leaving something on the table. Since the year 2000, the Dow has traded between, the S&P 500 in this case, has traded between 800, roughly speaking, on the downside. It got down to 660 at the absolute low in the year 2008, and roughly 1,600 back and forth since 2000 for the 12 years or 13-year period of time ending in 2013. So now we're back above that level. We're back above where we were in the year 2000, taking out basically that entire action, that consolidation action from 2000 through 2013. Is now the time to sell stocks? Well, if history is any kind of guide, the market's telling you that no, we're probably at the start of a new major secular bull market. And now is certainly not the time to sell stocks and move away from equities, although they are up 150% in value. Remember the bull market from 1982 through 2000 and the bull market from 1940, the mid-1940s until the mid-1960s as a guide potentially of what the equity market is capable of doing following moving away from major secular consolidation phases. Let's talk about the anatomy of a secular bull versus secular bear markets. Let's look under the hood, if you will, as far as how the markets tend to react and how they tend to trade during periods when we're in a secular bull versus secular bear. The most recent secular bull market, as I mentioned in an earlier piece, was between 1982 and the year 2000. Since then, we've been in a secular bear market that I think has probably ended sometime about 2 or 3 years ago. The 1980s through the year 2000, that secular bull market, stocks rose an average of 13.8% before dividends yearly. If you put dividends on top of that, the return in the equity market during that 20-year period of time, or 18-year period of time, was about 15% per year. During the 2000s, that decade from 2000 through 2010, the stock market generated negative returns in price by an average of 1.4% per year. Now, there are periods where the stock market did well during the 2000 era, but there are periods where things didn't do well at all. If you look at even further under the hood, and you look at the percentage of years during the secular bull market, from 1982 again through 2000, where within the year itself, the stock market declined by 20% or more. Percentage of years that happened during that period of 1982 through 2000 was 9% of the years. During the decade of the 2000s, from 2000 through 2010, 40% of the years saw a 20% decline from peak to trough intra-year during each year. So almost half of the years you saw that kind of downside volatility during that secular bear market. The average intra-year decline, the average move on the downside, if you will, for each year during the secular bull market was 12.1%. The average intra-year decline during the secular bear market is 20.5%. So let's talk about the stock market over the last 2 or 3 years. The stock market over the last 2 or 3 years has been up 13.7% per year on average, very akin to the 13.8% return we've seen per year from 1982 through the year 2000. The number of years where we've seen a 20% decline or more from 2010 till now is 0. We haven't seen a 20% move on the downside or more. So we're probably due some kind of contraction in the equity values. But even if we see that contraction, in our view, would be normalized in relation to being in a secular bull market again. Our view of this is still tentative. We're not particularly completely convinced that we're in a secular bull market, but it sure is feeling that way to us. What does this mean for investors? Instead of looking at the equity market as a trading vehicle, we're suggesting to investors you may want to look at it as an investment vehicle. Putting positions or buying positions in U.S. equities for the long run exposure probably makes more sense now than it has literally since the year 2000.